Samir Arora joins us now. Samir, good morning. Thank you for joining us. 2 weeks, not even 2 weeks, 10 days, and everything has taken a U-turn. Do you think we've topped out for the year? Are we in for more consolidation, more sweating, more pain till the end of the year?
Well, that is difficult to say, but in general, the normal peaking, at least in the short term, happens when IPOs get oversubscribed 100 times and they open 100% higher. So if you see the same thing happened in US with snowflakes opening more than 100% higher after raising the price by nearly 50%. Similarly, things are happening in India. But I would say this is, a global thing, so we won't be able to say exactly that whether this is the high or not for the year. But I still don't feel so bad. I mean, obviously, we are all feeling bad for yesterday and today and maybe another day before that. But still, things are, stocks that had to do badly are still doing badly. And in some other sectors where maybe we are all projecting the current trend to be up the same way, the stock prices are higher. So I can still justify most of what we are doing.
Would you be a buyer on every fall, Samir, or would you wait it out for earnings, better visibility, perhaps clarity on what managements would do? Would you use the decline to your advantage to preempt what corporates are likely to do, or would you really wait for crystal clarity along with the quarterly numbers?
No, you will never get 100% clarity. So our thing is that because we are a long short fund, at least in the main fund, so what happens is that we can sometimes cover a few shorts initially and then only go long, or sometimes we trim some of our longs only because we feel that maybe we like the stocks, but they are in a shorter term correction mode. So right now I would say it's the other way around. Maybe 3-4 weeks back our net was very high at about 76-77%, and now we have it at around 70%. So in theory we are already higher than our average longer term net, which is 60. So to increase it right now may be more a shuffling case rather than actually increasing the exposure. But the question is whether I will make it 60 or 50. That I'm not planning to do right now.
The sector which in a sense has delighted us, Samir, in last couple of months it was pharma, but couple of weeks actually has been IT. Now, is there a frenzy in IT, or this is the new reality which we must accept in IT, both in terms of prices and P multiples?
I think that the reality is that in a universe, you have to just separate winner from loser. Now, of course, you can take different horizon over which you analyze that, whether these are winners or losers in a sort of a closed universe of, say, 300 stocks. So I would think that IT is doing well, A, because IT is doing well, and B, because other sectors are doing badly, and therefore there is a shift. Even for us, over the last 6-7 months, we have gone from about 13-14% exposure in IT to something like 22% or something. And therefore, it is even in a sort of in the same fixed amount of money also people would be reallocating, because it is all relative choices that we have to make. Plus, because in India, there is no clear pure tech stocks. So we all buy IT as saying, okay, indirectly we are participating at some level in the US tech market, which is what everybody should otherwise have been doing. And therefore it has this second sort of attraction that pure tech stocks, pure internet stocks are not available in India in the same way that they are in the rest of the world.
All right, so that's on IT. Samir, we were seeing this unusual situation in the world currently where we are seeing the beginnings of what could possibly be a tech sell-off. Jury is still out on that. We're starting to see some amount of trepidation set in even back home, wondering whether or not this is going to build or it's just consolidation at these levels. What's your sense? Is the world watching out for signs of really whether or not we're going to recover past all the coronavirus news with parts of the world continuing to implement fresh lockdowns? Or do you think it's just that the markets are feeling a little overbought at these levels?
I think people were more looking at it as overbought rather than thinking that something has gone wrong with Amazons and Facebooks and Netflix. So I would think it is more that we are on our own are not playing the unlock trade in any meaningful way, as in buying theaters or airlines or anything or auto, where the assumption is that things will go back to normal in the next quarter or this quarter or festive season, or somebody will open a theater and therefore somebody will go and see these movies. Because in India, we have all been left to our own this thing, that each person for himself, in terms of saving himself from corona, there would be less comfort that how the system will help you if you actually have the problem. And therefore, at least for India fund, makes no sense today to be buying on hope. So I would think that the work from home and all, which initially, by the way, I must say, the first few weeks of this lockdown, I thought that this cannot sustain. People would feel like going to office. Even I go to office very, very rarely, although technically our office is open now. And it is quite comfortable. Today I was reading in Financial Times a story as to why the markets might be in a bubble is because the investors might be living in a bubble, which is possible because the fund management industry, the investment industry, the rich investors are very comfortable working from home. And therefore, they will play on recovery and unlock, but they themselves are not willing personally to go to malls and restaurants and theaters. And at least I don't see on Twitter in India people saying, here I am in a restaurant, or I'm in a mall, or I went out. But they all want everybody else to go out. So I would think that still the tech attraction will be there for some time. And this idea that when a vaccine comes, suddenly the work from home stocks will be sold off may happen for a short period of time. But some of these trends are, anyway, they were happening. It is just that the COVID has accelerated them. So they may plateau for some time and all that, but generally these things will go on till they reach a logical conclusion.
Okay, fair enough. So uncertainty really continues to reign supreme over the next few months. I also want to ask you on the way that the dollar is shaping up because of the kind of impact that may have on certain pockets going forward. There seem to be completely polarized views on whether or not we're going to see this crash or whether or not it's going to continue to be supported.
So I would think that, the original attraction of the dollar, first of all, who knows beyond a point on dollar? We are not that macro traders. But in a big picture sense, I would have thought that there was attraction for the dollar over the last 4 or 5 years because there was a big interest rate differential with, say, euro and yen, where the rates were much closer to zero. And the US, at least, you could get 3-4%. Now, as the rates are nearly the same and you will get 0.25% or something per annum in the US, it is the attraction of holding US dollars for their own sake looks a bit unlikely. And therefore, in that sense, I would think that and also the Federal Reserve is saying they will keep interest rates low for long and all that, and they need more stimulus and fiscal stimulus. So they will have to loosen everything or keep it loose. So I would think that will work a little bit in emerging markets' favor and maybe India's favor. But we have not ever had the confidence or the insight to play only on this logic. This is just there in the backdrop, and when it comes, we are delighted with it, but we don't exactly know how that leads to people buying India. But if you see last month, where people actively had a choice of doing what they want, India got 6.2 billion or so from FIIs, which is the highest monthly inflow ever in the history of FIIs in India. So somewhere this thing is playing, but who knows exactly.
Samir, morning. Speaking of the strength in the dollar as well, we've seen gold fall to that 2-month low. What's the sense that you have as to when it comes to gold, investing in this as an asset class?
You got mixed up your questions with what I should be answering, because I am not a macro trader. I am an India equity long short guy, and my gold views are basically for my personal, this thing. I don't when you're presenting or when you're talking to clients, you should have some history and some track record, which on gold I have zero. All I can say is that I personally own maybe 8-9% of my personal net worth in gold, which I substituted from debt. But beyond that, I have no credible claim like I may have on paper of 25 years of outperformance in India. But on gold, who knows beyond a point? But it feeds off the same thing that when I was thinking of, I was planning to buy an apartment somewhere in the world and I was to do that in this summer, which now is not happening. So the rates at which this money was lying were now being offered at 0.25% per year. So I said, go to hell, I'll just buy gold with it. But the general thing is that beyond that, I have no claim to be advising others on gold.
Okay, so let's talk about comfortable territory then, and the overall consumption theme, because this as well as a space is lagging considerably on the back of the pandemic fallout. Are you deriving any sort of comfort within consumption, or is this a space that you would wait and watch to see how progress follows
So our
through,
thinking
be it
is that
within consumer
investment
durables
in
or the
home. Yeah, so we are thinking that investment in home people are doing around the world. Whatever I read in US and even India, that means because people are now spending more time at home, and they have saved money over the last 6 months in not going anywhere else or not spending on traveling or restaurants or whatever else, and maybe even personal shopping. And they are looking at their house and wanting to improve various things. So that is happening. Unfortunately, there are not very many listed companies in that space. But overall consumption at a very macro level has to fall. There is no choice in that because there are job losses, there are increment cuts, there are salary cuts, there are delays in hiring. So at a big picture, it has to fall. But within that fall, I would think investment in home is, a theme wherever it can work. But beyond that, the idea is that I don't like the consumer stocks in India as much as I liked them, say 6 months ago. Again, it's on a relative basis because if the money has to be allocated more to tech or maybe a little bit pharma or even these new internet IT type companies or some specialty chemical or something, from where should that money come? It could have also come from financials, but financial stocks are down 30-40%. So you feel that maybe some part of the problem is discounted. Whereas in IT, whereas in consumer, we have stocks that are up 20% this year after having decline in earnings of 30-40%, and which the 20% rally would have been increase would have been a great performance if the country had done well, the economy had done well, the company had delivered well. Then at the end of the year, you were supposed to make 20%, which would have been a good return. But these stocks are up 20% when the economy has done badly, and those stocks have not been able to totally protect themselves from that lockdown, and their earning has been delayed by, say, 18 months, but the stocks are up as if everything is hunky-dory. And so therefore in consumer, we have reduced our exposure, and because we had to buy these other things and for its own reasons, plus the relative reasons.
Samir, I want to talk about the financials. We've been hearing about, there has been this constant push towards opening the economy. It's been slow. While there's ample liquidity, there are still complaints about that being passed on. And and businesses getting loans, so on and so forth. Most of the big banks that we have spoken to talk about how they're well placed naturally, and that they aren't seeing too many problems on defaults, etc. But we're just not seeing the banks move at the moment. How's your reading of the situation?
So we have all these big banks, and two of our biggest disappointment this year, by the way, we own both, have been. One is ICICI Bank and one is Bharti. So the point is that sometimes we don't understand why they are down as much as they are down. But because we liked them at that time, we like them now. But, it's a bit disheartening, but it also shows that how you have to have a portfolio of reasonable number of stocks, because whatever you may have the highest confidence in December does not deliver, but the overall package has delivered because of some other stocks where you may have had actually a little less confidence in December because there were newer names or different names. But yeah, truly financials have done badly, but there is some logic, of course, because every day we find that either the government or the courts, and now this new case on interest on interest, and then moratorium and definitions of moratorium. So it will take time. We are just believing in the history of these guys and in the history of these bigger private banks doing well and being disciplined in life, at least these 2-3 banks. And we hope that whenever things turn around, the fact that these stocks are down maybe 30-40%, or maybe HDFC Bank is down 20 and ICICI is down some 35-40%, and Kotak is also down similar, I think 20% or something. But there has been such a big change of CEOs in every company, and our government suddenly wants to clean up things, and they want to force out CEOs, and whatever we can do on our own as a country, we do in creating more volatility, more uncertainty, and whatever, and not give anybody any benefit or room or time. Suddenly we become the holiest and thou country in the world. So it's okay, but at least you can say that the stocks are down, and therefore by holding them you are assuming that this is a 1-year problem, or the problem is less than how much the stock is down. It is more difficult to hold on to stocks which are up 20% when you know that their earnings will also be down and that their valuations were such that making 20% in a strong year would have been a good return. So we hold them, but obviously they have not helped us this year.
Samir, viewers know that you run a long short portfolio. Some of the short positions which you had a couple of years ago, that you went short on metals, ADA group of companies, anything which had debt, you decided and had a broken balance sheet, you remain a structural short. Similarly, you were structurally long for last couple of years on private banks and few IT names. So if you have to, let's say, talk about a structural long and a short trade for next couple of years, where price action could be a function of volatility and technicals, but in terms of direction, it will be much lower than where it is in coming years, and it will be much higher than where it is in coming years. What would be that assortment?
On shorts is that shorts, although many shorts like telecom we had for maybe 4 years, and some of these other near bankrupt companies or 1 or 2 NBFCs, now we are not looking at them like that, but we have 2 of the highest P, highest rated, actually 3 of the most favored buy and never sell stocks as our shorts. So in short, and there are many others, we have many lockdown shares, auto shares, airline shares, theater shares, movie chain shares, many of them we are short. But the thing is that in shorting, the first idea is not so much that you will make a lot of money, which by the way you end up making only in these bad months, otherwise you actually don't. But the idea is that they should be low probability of you getting squeezed out of shape because suddenly these stocks are up 20% and 15% or even 10% in a settlement or less. And so the idea first is that it should have low probability of going up for whatever reason. It could be very high valuation, very ridiculous assumptions that suddenly people will start traveling, blah, blah, blah. And then it feeds on itself, and because the market is so volatile, it sort of works itself. So just to give you some big picture numbers, because mostly you don't make so much money in shorts over a very long run. So for us, say for 15 years, the market, while we have been investing in this long short fund, the market is up 600% in rupee terms. And we have had, say, 30% short book. And cumulatively, we haven't lost money. But it's not that we made massive amounts of money if you look at it over a full 15-year period. But in various years, because the market itself is up 600%, and therefore in theory you should have lost whatever. But so right now we are making, or we made in some of these months, big amounts, so that overall it helps and you're able to get ahead of others or whatever, or index. So I wouldn't say today that I'm talking about, like we had telecom for 5-6 years, we started the stock at 200 and covered it at some 8 rupees or something. So there was some like that. Right now we are not thinking like that. Right now we are just thinking that it is ridiculous that some consumer company should be trading at 60 multiple and they are not going to grow, and just because somebody says that they did well in the past, therefore it is in every year, every period that should. But if they were to correct 15%, some of them have, maybe we will go to zero, or maybe we will go long. But all we are saying is that there has to be a cost for being stuck even in a lockdown economy. It is not enough to say that I am a good guy, but my sector or whatever has been locked down, so I couldn't grow.
Yeah, there's a graphic which our viewers can
The
see
volume
since
is very low.
lockdown. We've put Bharti and
Yes.
Reliance together. Bharti is up 4. No, I'm saying, Samir, just for the benefit of our viewers, we've put a graphic on air and I'm coming to you. Bharti is up 5% since lockdown and Reliance is up 150%. So, Samir, you understand, the big picture, the new themes. You've always, in a sense, invested in things which could become large, both in terms of scale and size. How would you play on this entire data migration? You spoke about work at home changing. You're speaking about how people are comfortable working from home. If digital is a new reality, minus Reliance, is there any way else a ordinary investor can actually invest in this whole digital ecosystem?
Unfortunately, very few companies are listed. We have InfoEdge and we have India Mart and all, but they are okay. We have some of them, but on this Bharti versus Reliance, we have both. But Bharti has been disappointing. I am unlike other fund managers who says that if I own a stock, then I can't talk negatively about it. If I don't own a stock, then it must be the worst stock in the world, because there are stocks that we own and now we are upset with them. And there are stocks that we don't have and we feel that we had them and we would even tell. So in Bharti, by the way, we have it from maybe end of last year or a few months before that when that QIP happened. But the thing is that they have not taken any initiative. They are only reacting and justifying what Reliance is doing. Some of the things which Reliance is doing, they could have done. I am now a bit tired of them saying we are waiting for price hikes and all, which, by the way, we also bought on that basis. But now that you look back in hindsight, every day to only say that, and actually, I got upset on the right day, but unfortunately I didn't act. And that was on the day before the Google announcement, which at that time nobody knew that whether the Google announcement will come in, except that the leak had come. Bharti announced that they are doing a major announcement that evening, and then they announced that they are launching some Zoom copy called Blue Jeans with Viacom of US, not Viacom, sorry, whatever that US telecom company. And the way it was hyped up before, as if some earth-shaking counter strategy is happening. So in that sense, but we own it, because the logic, big picture is still there, that they are riding on the industry thing that let Reliance fight and get rid of Vodafone, and therefore we will be the second guy either way. I think they're taking that too seriously, that in any case, even in this competitive landscape, if Reliance cuts prices, okay, doesn't matter, because in the end, that will just drive out the third guy and then I'll be the second guy. But I think that they should do something more on their own rather than let this be where they're only reacting. By the way, it's one of our bigger positions, maybe in the top 7, 8 names.
All right. Thanks for joining us this morning, Samir. Always a pleasure. And have a good day.